In this video, we're going to talk about a more sophisticated, long-term Theta Gang strategy that leverages covered calls and cash-covered puts to build a regular stream of income. It's called the wheel. When you run the wheel, you're constantly selling covered options to collect premium so you can build a portfolio or, if you want, withdraw money for life's expenses. For that reason, the wheel is versatile enough for both young people and retirees alike. The wheel works by leveraging covered calls and cash-covered puts. So if you're not familiar with those, check out these videos first. For those that are ready, let's get down to it. You begin the wheel strategy with a big pile of cash, enough to sell a cash-covered put on a stock that you like. And you jump on the wheel by selling that cash-covered put. You collect your premium, and you can throw it into your cash pile, or withdraw it back into your bank to buy beer and pay bills. It's up to you, because it's your money now. Now that you've collected your premium, you wait until expiration to determine what to do next. If the cash-covered put expires worthless, then congratulations, you made a great trade. Just back your wheel up, sell another cash-covered put, collect more premium, and repeat. If you keep that up, you'll get rich off of the premiums alone. But if you're selling cash-covered puts, then eventually you will get assigned. And when that happens, you will be forced to buy 100 shares of stock at the strike you selected. You'll now have 100 shares of stock in your portfolio. And what can you do with 100 shares of stock? Sell covered calls. When you get to this stage in the wheel, you'll be selling covered calls to collect more premium to throw it into your cash pile. Now if that call expires worthless, then you'll keep your shares and you can repeat the covered call, collecting more premium. Eventually, the stock will close above the strike price. When that happens, the buyer will exercise that contract, your shares will get called away, and you will receive money for your shares. The wheel has just completed a full revolution, and you've made some money, potentially a ton of money. Jump back on the wheel by selling another cash-covered put and start collecting your premium again. The wheel will make you a lot richer. The goal of this strategy is to keep premium flowing in. So let's talk about how we can get the most out of the wheel. When you sell a cash-covered put, make sure it's a stock that you're okay holding. Tesla options offer very high premiums because the stock is volatile. But if you don't like Tesla, don't sell a cash-covered put just hoping to collect that premium. That's just gambling. Remember, you are expecting assignment when you run the wheel. So make sure that you're okay holding the shares if you get assigned. When you do get assigned, remember the next step is to sell a covered call, which means you get to select your selling price if the contract executes. So how do you select a strike? Consider your basis. You bought shares at the strike price of your cash-covered put. Subtract the premium you collected from that, and you have your basis. For example, if you sold one AMD cash-covered put at $30 and collected $1 of premium, your basis is $29 a share. So when you're selling a covered call, select at least the $29 strike. Preferably, sell a call with a strike above that. That way, you're making money in 3 ways. 1, from the premium of the put. 2, from the stock being sold above your initial entry. And 3, from the premium on the call. And lastly, don't sell the covered call if you really want to hold the shares. You have to accept exercise if it comes, so you can keep spinning the wheel. If you're going to lose sleep for every day that AMD is not in your portfolio, don't sell a covered call against it. Just save money until you have enough to buy 100 more shares through a cash-covered put. Once you start spinning the wheel, you're likely to find that you're actually making money. And if you're a Wall Street Bets trader, this might be the first time you've ever seen green. So let me share with you some of my views on how to use this premium intelligently. My preferred strategy is to spend that premium on shares of whatever stock you are wheeling. If you follow my Robinhood 3K challenge, you'll see that this is what I'm doing. I'm using it to build a portfolio. This second choice will probably be popular among the degenerates at Wall Street Bets. Use the premium to buy FDs. If you made $100 in premium, go ahead and buy some deep out-of-the-money puts or calls. That way, when you lose, you're only losing this week's premium. You're not losing your tuition money. The third choice is a lot less sexy, but it's probably a lot smarter. Use the premium to fund a tax-advantaged account. Maybe you need to fund your Roth IRA, or you want to buy some tax-free municipal bonds, or a life insurance policy. Maybe you want to invest into a tax-deductible 529 college savings plan. That way, you make sure you keep your tendies, and some of these instruments can actually lower your taxes, so you're making money in that way too. And for your last choice, imagine actually using some of your tendies to buy things that you want other than investment vehicles. It's an alien idea to some people, but this is great for old people in retirement or people that just want to do something fun. For example, I ran the wheel on Google while I was on vacation in Thailand, and the premiums paid for almost the whole thing. 2 weeks in Thailand cost me about $300 because the premiums paid for flights, hotels, and lots of other fun stuff. Before we wrap this up, let me give you a couple of tips based on my experiences running the wheel. First, selling weekly options is better than selling monthlies in terms of premium. For example, you might get $250 from a monthly covered call or $80 a week by selling weekly. Over 4 weeks, you'd end up with $320 instead of $240. But do keep in mind that that assumes you're selling all 4 at-the-money contracts. Things often don't go that way. For example, assume you sold a covered call of AMD at the $30 strike. If the stock were to drop down to 26, you'd obviously collect the full premium, and of course, you wouldn't get your shares called away. However, if your basis is 30, you're not going to want to sell covered calls at the $26 strike, and if you sell at $30 strikes, you won't be getting much premium. In that type of situation, you probably would have been better off selling one longer-term option rather than trying to sell 4 sequential at-the-money contracts. Also, be careful around earnings. Volatile stocks like Roku have crazy high premiums around earnings, but that's because the stock is likely to either fly or crash after the earnings release. Only mess with earnings if you are willing to get assigned or to lose your shares to an exercised covered call. Lastly, when you're selling covered calls, be aware of early exercise before a dividend. If your call is close to expiration, someone might exercise early if the dividend is higher than the distance out of the money. For example, if you sell an Apple call and just 3 days before expiration, the contract is only 4 cents out of the money and there's a $1 dividend coming tomorrow, expect the contract buyer to exercise early because that $1 dividend is worth more to him than the money he loses by exercising that option. I hope this video has shown you guys how powerful the wheel can be. Really, it is a tremendous instrument for pulling income and building a portfolio. If you'd like to see it in action, I invite you to check out my segment on the Robinhood 3K Challenge, where I milk the wheel for all it's worth. Thanks for watching, and I'll catch you all next time.